Notes receivable is very similar to accounts receivable. Instead of one of our clients or customers owing us money, this is when we have a promissory note, which is a written promise to pay a specified amount of money, usually with interest, either on demand or a stated future date. This means that we kind of like loaned money to someone. Instead of making a sale and saying, okay, pay us later, we're doing like a straight loan. And they do have to sign this note stating that they're going to pay us back. It's a little different because it also has interest. This is an example of what a promissory note looks like. Kind of looks like a check. These can actually be really lengthy contracts. This is just a very simplified version of what would be discussed on it. It would be the amount that the person is borrowing that they owe us, the date, how many days they have to pay and who do they have to pay, and the amount of interest. And then, of course, the parties should sign this as well. Now I'll show you how to compute the amount of interest because that's really the calculations that happen here. If I loan someone $1,000, they're going to have to pay me back the $1,000 plus the interest. That's the part we really have to focus on calculating. Some key terms here first. The maturity date is the date that they have to pay us back. They have to pay us back the full amount of the note plus the interest. We call this the maturity date. It could also be the due date. To calculate the interest, we'll take the principal of the note of the loan. That's how much you lent out. The principal is the full amount. If I gave someone $1,000, that's the principal amount. You're going to multiply that by the interest rate times the time expressed in fraction of year. Whenever you have interest rates in terms of finance, it's always for a whole year. If I loan someone $1,000 and say there's 5% interest, and I say they have to pay me back in a month, it's not 5% interest over the next month. It's 5% for the year, and they would only give me 1 month's worth. This is also how your credit cards work, your car loans, all that type of stuff that you have. The interest rate is not on a monthly or daily basis, but it's on a yearly basis. You might get charged interest every month, but it's only a fraction of it. A lot of your credit cards might be at the 20-something% range. If you look at what you're actually charged in interest, you're not being charged 20% of your bill every single month as interest. That would be outrageous, and you would never be able to pay it back. It would be that 20% for the whole year. This is really good to understand how this works now when you're at the point in your life that you might actually start getting credit cards and taking out loans. We're going by the banker's rule here, assuming that there's 360 days in the year, which is 30 days every month. For example, if I loaned the $1,000 loan to someone with 5% interest, I would do $1,000 times 5% interest. And then I would figure out how many months it is for them to owe me the money. Let's say they owe me the money in 3 months. It would only be 3 out of 12 months they'll need to pay me the interest for, not for the full year, not the full 5%, just 3 out of the 12 months in the year. We'll do some examples to go over this though. Next, we'll be discussing how to do the journal entries for this. For the initial sale, instead of it being accounts receivable on our books, it'll be notes receivable, implying that there's interest involved. The credit would either be sales revenue or cash, depending on the situation. If you're just loaning someone money, it would be cash. If you sold them something and they're going to pay you later, it would be sales revenue. Most of the time, it would be accounts receivable and then sales revenue. This would be if we're kind of like sticklers saying, hey, yeah, you can pay us later, but you're going to have to pay us interest if we're extending you this credit. Maybe it's a new customer, you don't really trust them so much, so you're trying to mitigate your risk a little bit. But in this case, there would be interest involved and someone does owe us money. At the end of the time period, we'll have to record the honored note, meaning that they're going to pay us the amount they owe, plus they're going to pay us for the interest. Note that this textbook does go over dishonored notes when someone does not pay us, but we're not going to get too technical with that. All I want you to know is the initial sale of the note, and then getting paid from the note. Now, this is a journal entry when they do pay us in the same accounting period. The next slide will go over when the note spans over multiple accounting periods. But here at the end of the term, we're going to get the money back from the note, however much they owed us. In my example, it's been $1,000 plus the interest, whatever the interest is that they owe us. That will be the amount of cash we're going to receive. Remember, debits have to equal credits. So the note plus the interest will be the amount of cash I'm receiving. Once again, this is if it's in the same accounting period. For instance, it's 2020, I lend you the money in 2020, and then you pay me back in the same accounting period. It doesn't go into next year. We'll discuss that next. Let me show you an example of why we're doing what we're doing next. If I lent you money sometime in 2020, and think of this as a timeline, this is the end of the year, and then we get into 2021. If I lend you money sometime here in 2020, and you paid me back in 2020, we would calculate the interest for this time period. I would get the money back along with the interest. That's the journal entry I had just showed you. Now let's look at it if it expands more than one accounting period. Let's say I loaned you money in 2020, but you're going to pay me sometime in 2021. You're going to pay me the initial amount of the loan plus all of this interest in this time period. However, we end our year here, the end of December. We have to show that we actually earned interest in 2020. Then in 2021, we have to show that we're earning the rest of the interest, and then we're going to get paid the full amount. We have to do one journal entry here at the end of the year to say, hey, even though I have not received the interest yet, I'm going to, but I earned it in 2020. Then we do another journal entry when the note is honored, when we receive the money saying, hey, we got all the money from this time period and all the interest from this time period as well. The first journal entry at the end of the year will look like this. We'll have interest receivable. It's the amount of interest we earned in that year that they owe us for, and they're going to pay us the next year. And interest revenue as the credit to show that I have earned money last year. In this current year in 2020, even though I'm not going to get paid for it until next year, it's still revenue in this year. The next journal entry would be recording us receiving the money. We will get the full amount of the note back, plus the interest receivable, the amount that we earned the year before. That number will go here. Plus interest revenue would be the amount this year. So for my example, the interest receivable would be the amount we earned in 2020. Interest revenue would be the amount we earned in 2021. When you add this together, it's the full amount of interest for the full time period. We take the full amount of interest plus the note amount. That's how much I'm receiving in cash. Remember, cash has to equal all of this added together. I know this is a little tricky, but just try to follow along the best you can. We're going to be doing the last practice problem, number 6 on your classwork. Dog Company's December 31st year-end unadjusted trial balance shows a $10,000 balance in notes receivable. This is the principal amount of the loan. The balance is from one 6% note dated December 1st. 6% is the interest for a whole year. Remember that. On December 1st is when we gave out the loan, and is a period of 45 days. That's when they have to pay us. Prepare journal entries for December 31st and for the note's maturity date, assuming it's honored. To visually show you what's going on here, on December 1st, we gave out the note, and then 45 days later is when they have to pay us. If we gave out the note on December 1st, they would owe us in the middle of January. That's 45 days later. It's a month and a half. Remember, just assuming there are 30 days in a month to make this easier. Our first journal entry will be done on 12/31 to show the amount of interest earned during this time period. from December 1st till December 31st. It's a 1-month time period. How much interest was earned during 2020? Remember, we're not going to get that money until January 15th, but we did earn it in this year. We use the formula where we take the principal amount of the loan, which is $10,000, times the interest rate, which in this case is 6%. That would be the interest for a full year, but we just want 1 month. There are 2 ways to do this. The way the book does it is they do times 1 out of 12 months. The way I do it, it's a little different. We'll start off the same. I divide by the 12 months, and then I would multiply it by the amount of months that the time period's for. In this case, it's 1, so I would just leave it as this. Regardless on how you do it, it does not make a difference. You get the same answer. 10,000 times 6% times 1 out of 12, just for 1 month, would be $50. This means during this time period of December 1st to December 31st, I earned $50 in interest. This is the first journal entry that we need to make, is to show that right there. As a reminder, the entry is interest receivable and interest revenue. The date is 12/31. We'll put the entry in interest receivable, interest revenue, what I just showed you, and the amount that was earned in this year, which was $50, which we just calculated. Now I'll try to figure out what the next entry would be. We have to calculate what the interest would be now in this time period, and then we're going to add it to the last time period plus the principal to figure out our cash amount. From December 31st to January 15th, it's only half a month, 15 days. If $50 was the amount for a full month, then how much interest would we earn for half a month? It would be $25. Therefore, the full amount of interest we're receiving for the whole life of this loan is $75, but 50 of it was earned in 1 year, $25 in the other year. And that's what we're journalizing now. We're going to show that we're receiving the $50 we were owed from last year's interest, plus the $25 from this year's interest, plus the full amount of the loan, which was $10,000, and we're receiving all of that in cash. I'm going to go a little backwards here with doing the journal entries. It's going to be on the 15th of January. That is the maturity date. The amount of the note is the full balance they owed us, which was $10,000. Interest revenue would be the interest from this current year, basically from January 1st to January 15th. This year's amount was $25. Then we're going to add to it the amount from last year. That's the interest receivable here. Whatever amount you have there would go here. We were owed a total of $75 in interest, 50 of it from last year, 25 from this year. How much cash are we getting in total? It would be the sum of all of this together, which is $10,075 in cash.